Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show.
Welcome to the i3 Insights podcast. My name is Daniel Grioli and I'm the Market Fox columnist for i3 Insights. One of our aims for the i3 Insights podcast is to chat with a wide variety of guests drawn from different parts of investment and finance. We encourage our listeners to check out previous episodes of the i3 Insights podcast, where we consider all sorts of topics, including asset allocation, emerging markets investing, after-tax investing, and qualitative investing. You can also follow us on Twitter at i3invest and at market_fox. Today I am joined with Mike Cantara. Mike's a Senior Managing Director with MFS in Boston. He holds several roles within MFS. Most notably, he serves as the co-chair of the MFS Sustainability Group. We're going to talk today about all things ESG, that's environmental, social, and governance investing. But first, we're going to find out a little bit about Mike and how he came to work with MFS on ESG. So without further ado, I'd like to welcome Mike to the podcast. Mike, thanks for joining us today.
Thank you very much for having me.
So tell us a little bit about yourself, Mike. How did you get started in the industry?
As I mentioned before, I'm based in our Boston office and am local to, or a Boston native, I guess you could say, a New Englander, and came into the business almost 30 years ago. And initially at Fidelity, where I spent about 10 years. In the last 18 plus years, I've spent at MFS in a variety of roles on the investment side and then more recently on the distribution side. And much of that time has been with a focus around sustainability.
Okay, so tell us about your first job at Fidelity. Where did you start out?
I actually started in what was then known as the Fidelity Management Trust Company. So this was the precursor to the institutional business and a focus there on non-U.S. portfolios. So I started as a portfolio analyst working on EFA strategies. And then that eventually grew into taking on responsibilities for or getting involved in our global equity strategies at MFS.
So I'm thinking back 30 years ago, non-US investing would have been quite novel, I'm guessing.
It was, and I remember the early days of a lot of work proving the case of the home country bias and the benefits of diversification. And of course, at the time, there were lots of capital restrictions keeping money at home in many countries around the world. So we certainly have evolved from there, where now it seems to be almost a seamless integration of everything global, both on the fixed income side as well as on the equity side. So things do change.
Did you always want to get into the investment business?
I think it came at an early stage where I had always gravitated more in the math direction, had an interest in investing, and then I think it kind of was crystallized for me at an early age with perhaps an interesting or relevant story, and that is I grew up, as I said, in New England, in Maine specifically, which is about a 2-hour drive north of Boston, and went to a Catholic school as a young boy and came home one day and told my mother that I was thinking about the priesthood. And she was very intrigued by all of that and asked me a bit more about my rationale. And the rationale was the priest in our parish happened to drive a Mercedes, which in the early 70s in rural Maine stood out quite a bit. And I then came to find out that it wasn't actually his Mercedes, and decided that I was going to probably change my profession, not so much to that sort of calling, but thinking about where can I go from an investment standpoint. So that was certainly an early experience that got me set down that path. Much to the disappointment of my mother and grandmother, I might say.
Well, it's quite a different vocation, isn't it? I guess
it is
to the priesthood.
It is. There are probably many differences, but I guess you could find some similarities if we looked hard enough.
Interesting. So, back in the early days, who were some of the important mentors and influences that helped you along the way?
I think, influences and mentors are different categories, but certainly well-known investors, Peter Lynch, going to Fidelity, couldn't help but really follow what he was doing. I never worked with him directly, so an influencer. Mentors, I was fortunate, I think, to have a few over the years at Fidelity. A gentleman by the name of Bill Fink, who managed the international portfolios, was really instrumental for me at a very young age, kind of understanding the differences between cultural differences between markets and the makeup of different markets around the world, which was really fascinating to me, thinking about it, for so long just from the U.S. perspective. And then, of course, at MFS, again, fortunate to have a number of mentors. One of the first people I met at MFS was a woman by the name of Joan Batchelder, who headed up our fixed income team at the time, and I interviewed her when I came to MFS, and she was a great mentor at the time. And then on the investment side, working very closely over the years with Dave Antonelli, who's vice chairman of MFS, Dave Mannheim, who's a previous portfolio manager at MFS, I think were some of the real key influencers and more importantly, in this case, mentors for me as I was evolving through my career.
You've moved through Fidelity. You're now at MFS.
Yeah.
How did you end up at MFS?
It was, it's one of the chance encounter where, believe it or not, ran into an old colleague at a playground with my son, who was very young at the time, 2 or 3 years old, and just got talking about career developments, and she put me in touch with a few people at MFS, which was a great opportunity, really, to learn more about what was going on at MFS at the time. And the timing was terrific, because I did end up spending a lot of time at MFS on the global equity strategy. So that got me to Australia quite often in the early 2000s, and have been coming back ever since.
Very good. So tell us a little bit about the investment approach that MFS uses. Just for our listeners to have a bit of background about.
Well, I think in a nutshell, when we think about what is it that we're doing at MFS and why would clients hire us, we truly do believe that it is our responsibility to allocate our clients' capital over the long term to enable them in a sustainable way to really meet their long-term outcomes. So there's a lot in there, but really just a common sense approach of having the discipline to be a long-term investor and focusing on what we think and what our clients tell us really matters to them, and that is the end result or the outcome, which oftentimes requires a very long-term investment horizon.
So as part of this long-term investment horizon, was sustainability always a part of the investment process, or when did that start to become more explicit in the investment process?
It's an ongoing debate within MFS, because we have this discussion oftentimes where this is not new. When we talk about ESG or sustainable investing, the labels are new. The amount of data that's available is different or new, but understanding what a management team's strategy is for running their business over the long term, and then what are the material elements that can affect that, has been part of what we've always done. So you referenced earlier my role as co-chair of our sustainability group, and that dates back to 2009, where we started with what was called then our Responsible Investing Committee, which was our first real look at signing on to the UNPRI, the Principles for Responsible responsible investment. And we were able to get comfortable in doing that in 2009, 2010, because it's so consistent with what we have always seen as our mandate, and that is to really look at the elements that will have a material impact on the company's valuation and future prospects over the long term.
It might be helpful for our listeners if you can provide a bit of background about what is involved in signing up for the UNPRI, and perhaps tell us a little bit about MFS's experiences since becoming a signatory.
Yeah, we think the big benefit of the PRI is that there's a lot of organization, and a lot of the work being done now is really to develop frameworks and evidence. And so frameworks which help not only asset owners but investment managers really understand how to establish the right investment policies, procedures, et cetera, to do that. And then on the evidence side, what we're finding, and we've had several of our ESG analysts and opportunities to get involved in collaborating on various projects, from tax avoidance from a couple of years back to more recently a lot of focus on income inequality and more social issues. So one of the big benefits we think is to allow us to collaborate with other industry participants in order to try and solve some of these bigger problems. So it's been a relationship that has worked out really well. In fact, we are going to be the lead sponsor of the PRI in-person event that's happening in San Francisco in September. So hope to see a lot of your listeners there.
Very good. So in terms of your clients, how have you seen their ESG journey progress over the last 10 years or so?
Yeah, I think it's, as we observe sort of on a global basis, we tend to think about three categories that we could kind of group investors into. And the first, the skeptics or the followers. So these are ones that still need a little more convincing. And then we would say the believers. So there's evidence there, and it's more a matter of figuring out what to do next or how to move the process along. And then there's a category that I would call leaders, which are really at the cutting edge of a lot of the newer elements, I would say, of ESG investing, and a lot of times that means impact investing or having direct investment. So that is still a relatively small cohort, but I think is particularly within the institutional space, led by many of the Nordic countries, certainly led by Australia, New Zealand, with some of the superannuation funds there, and I would say Canada is another area. The notable absent from the list is the U.S., and although there are some leaders in the U.S., I think as a region, as a country, still further behind other parts of the world.
So if you had to put the US in one of those three buckets, the skeptics, the believers but unsure of how to progress, or the leaders, from your comments, I'm guessing they're not in the leaders. So would you put them in the average US investment group into the skeptical bucket, or the not sure how to progress bucket?
I think more in the believers and trying to figure out what to do now. I think there's too many powerful trends that are happening to really deny that. And by that I mean, for a while there was a lot of back and forth and debate about the academic research. But when we look at it now, 90% of the academic studies do verify that there's at least some positive correlation to financial performance for companies that pay attention to material factors. And I think that's an important distinction maybe we can come back to. But also really thinking about how that gets implemented. The skeptic part of this, I think, is still there, and a lot of that, I think, can be seen through the lens of the current administration in the U.S., where pulling out of the Paris Accord, rolling back a lot of things that are related to regulation. Again, not ESG specific, but just the general trend. But despite that, what we're seeing from the industry is companies are still signing up for those scenario targets, and investment managers and asset owners alike are still pursuing this path. So to me, that's encouraging, because it does imply, at least as an industry, that we're not going to wait for regulation to tell us what we should be doing. We're figuring that out. And so that's why I think you're starting to see more move squarely into that believers camp from the U.S. side.
Okay. So you've told us a little bit about the journey at MFS and what's happening on the client side of things.
Yeah.
How about with companies themselves? What changes have you seen with companies over the last 10, 15 years on the ESG front?
Yeah, well, certainly there's been no shortage of glossy brochures on lots of corporate websites that talk about what each of these corporations are doing from a sustainability standpoint. But I think, more importantly, it's ending up in our engagements with the executive teams and boards when we're engaging at that level. There's, I would say, more of a requirement of transparency and evidence. And so a lot of the some of the marketing slogans that have been used regarding sustainability just don't cut it when we're talking about specifics with companies. So we're seeing, in some cases, CEOs or CIOs really wrestling with what's the right data elements, and I think that's at the heart of what the industry needs to solve right now. We've seen a tremendous amount of new data sources come out on whether it's climate or environmental risk or different measures of governance or social issues, worker safety, voluntary turnover. All of these metrics are becoming more commonplace, but we need a framework to be able to compare apples to apples. And I think that's kind of the state of where we are right now. There's a lot of great data, but how do we use all that so that we, at the end of the day, still have some comparison? So company managements are asking the industry for guidance on that. And there's a lot of work being done by SASB in the U.S. Organizations like the PRI are doing a lot of work to try and bring some of those frameworks together, which I think will be additive, certainly, into the overall discussion.
Do you think we'll ever reach a point where we have a common set of ESG reporting rules, similar to what we do with accounting, where you have GAAP or IFRS? Do you think that's on the cards? And if so, how far away is something like that?
I do think that's that's where we're heading, and I think we need to, I would say, be a little bit cautious on that front. But when I say SASB, that's the Sustainability Accounting Standards Board, modeled very much after FASB in the U.S., going back to the early 70s, and so that is a framework on a sector-by-sector basis where there's work being done to really identify what is material for that industry. And I think that is the key phrase that we keep coming back to. Simple example would be in the transportation sector, whether it's rail line or trucking. Some of the things that stand out as being very material, obviously, are greenhouse gas emissions as well as worker safety. When we look at banking, for instance, the material factors are going to be quite different. Those may still exist. Greenhouse gas emissions may be interesting to look at, but it may not be as material. But things like ethics practices or overall business practices would certainly come to the fore and be much more material. So I always come back to this, but there was a Harvard study or a paper that came out of Harvard Business School in 2015 really talking about this corporate materiality or the materiality, the first evidence of the distinction that makes. And through that, they were not only able to illustrate that companies that pay attention to material issues within their industry outperform their peers, but companies that pay attention to immaterial issues detract value over time. Very common sense outcome from my perspective, but I think it was the first time that I've seen at least real evidence to show that companies should not try to be everything to everyone. It has to be about what is most material to that business. And if we focus on that and continuously focus on that, then I think we have a better chance of really identifying the right investment factors over the long term.
I think that's a really interesting point about the importance of focusing on the right things.
Yeah.
So we've talked about a few different constituencies here. We've talked about asset managers, we've talked about institutional investors, we've talked about companies. One group we haven't mentioned, which is the end investor.
Yeah.
So what's happening with the end investor, the ultimate client, in terms of ESG?
Yeah, I think it's becoming a more important factor, and you can just look at sort of the demographic trends as one bit of evidence that reinforces that. Certainly, a lot of discussion and talk around millennials, but we know over the next 15 years, millennials are going to be 3/4 of the global workforce. These issues are important to them, not only as employees, but also as investors. A lot of the survey work that we've seen also show that women are much more interested in many of these issues. And so I think we see both of those as obviously important end users or constituents of investment services. And so that is one element that we're seeing come through more and more, demanding these types of issues. That is part A to the problem. Part B is how do you solve it, which is, oftentimes I think the industry overall is really good at creating product. And so the number of products out there, funds, vastly exceeds the number of stocks available globally. We know that. And I do worry a little bit that will be the industry's solution here, is to try and create product for everything. Our view is quite different. We don't think product's bad necessarily, but it doesn't answer the whole question. Integrating these practices into an investment process, we think, is a much more durable way to do that. So convincing that millennial that a portfolio run by a skilled manager that's focused on engaging with companies can meet their needs. But oftentimes we do need to think about what does that product look like, and how do we develop a product that meets the various values, I guess, of those underlying investors or retirees. And I might be concerned about sugar, you might be concerned about tobacco. So how do we really have a process that focuses on product? Through integration, we can go through a process that allows us to match what we're finding in the marketplace to those investors' actual needs.
Do you think technology could play a role in that it might allow the end client to opt in or opt out of certain things, basically vote their conscience, so to speak? Do you think that we could see a day when we could have the technology that would allow people to do that?
Yeah, I guess that could take on a couple of different forms, but the clear trend throughout all of any industry is that technology is driving a lot more efficiency in the dissemination of information. So certainly having more transparency, better access to that information would give end users, the clients, ability to maybe have a say in real time or close to real time in those instances.
You mentioned in your earlier response the importance of integrating ESG into an investment process and making sure that the client understands that. That's probably a good segue into talking about how MFS integrates ESG into its investment process. Perhaps you could take us through how that works and maybe offer us an example or two to.
Sure. So my starting point here is the fundamental law of active management. And so this comes from Grinold and Kahn. But basically looking at the alpha potential equals skill times the opportunity set. That's my English translation of the fundamental law of active management. And so integration is a process that enables us to not start off with a limited opportunity set. And therefore, we don't believe that we're limiting the alpha potential that we can provide as a result of that. So as a skilled manager, we would think of ourselves as certainly a skilled manager, having a very deep global research team, really charged with identifying or sifting through that opportunity set to screen out, not up front, but through our analysis process of companies that either meet our long-term criteria or don't. And so it is very much in that sense of integrating this into what are the long-term drivers of this business, how much visibility do we think we have into those drivers, whether they fall under an E, S, or G category or not, is kind of less relevant in many instances as thinking about what is the long-term valuation. One way maybe to put that in perspective, or at least how I think about it, using the U.S. as an example, the S&P 500, currently the overall market value of intangible assets to tangible assets of the companies in the S&P 500 is a ratio of about 84% to 16%, meaning 84% of the value of the S&P 500 is in intangible assets. That's brands, that's research and development, it's services, it's intellectual property, compared to 1975, where those numbers were basically reversed. That 80+% would have been in physical assets. The market cap of the S&P 500 would have been attributed to more to physical assets. So I think that trend to more intangible assets is very consistent with how we have to think about some of these ESG issues. They're long-term, they're meaningful. You can't point to it necessarily on an income statement or a balance sheet in each instance, but there is a real need to understand how is that executive team, how is that board really managing all of the levers that they have to pull to run their business. And what we're finding, because you mentioned technology earlier in reporting, that we just have more visibility into some of these E, S, and G issues. So as we think about it, talk to our analysts, talk to our portfolio teams, many of these things are not new, but we have more robust data to supplement that. And so that's really what when we think about integration, we're never from a starting point saying we won't invest in this area unless it's client directed. We certainly have clients that have specific missions or specific areas that they want to address, and might ask us to screen out certain sin stock restrictions or things of that nature, which again, mechanically is very easy to do, and so there's not a lot of value added in that process. In my view, we think the real value add comes through the integration and kind of making those hard decisions about where we want to allocate our clients' capital.
So do you have a separate team of analysts that's looking at ESG issues, or is the same analyst that's covering the stock, are they also looking at that company for its scoring across ESG-related issues?
Yeah, it's both. And so we do have dedicated ESG analysts, both on the equity and the fixed income side. And I would say that our overall integration is really trying to marry a bottom-up view with a more, I'll say, top-down or thematic view. So our ESG team focuses on specific issues. I mentioned tax avoidance earlier, income inequality, water scarcity. Some of these really big global issues are led by our ESG analyst, and then they are working side by side with our fundamental analyst. So we only have one rating on a buy, hold, sell rating system. We don't have a separate ESG rating. Again, this is integrated, and we only are looking for one signal: do we want to own this company or not? And then understand the thesis behind that. And what we're finding as we develop this more and more is that there's always two or three key elements to why we own that security, and more often than not, we're finding that E, S, or G is one of those elements, and so including it in that way is how we think about it.
Perhaps you could help our listeners with an example. You mentioned some big themes that the top-down ESG analysts are looking at, such as tax, income inequality, and also water usage. So how does a big theme like, because we're all aware of those issues,
right?
Let's take water, for example. Yep. In a lot of third world countries, water is a problem, and a lot of companies use it irresponsibly. They damage the water supply, they hurt the local population. So we all know that, but how does that actually translate down into a stock call?
Yeah. Again, it's really trying to build the mosaic and using the work done from our ESG team and the analysts on the ground that are responsible for those companies. So, I think a great example of that is some work that we did looking at Chinese beverage companies. And in this particular case, there was one beer manufacturer that was expanding their bottling operation and manufacturing production, but doing so in areas of extremely high water stress. And so that was something that we looked at based on work collaboration between our ESG analyst and the fundamental analyst on the ground. So the fundamental analyst was really able to identify where this expansion was taking place, and our ESG analyst, by locating some very specific water scarcity maps, was able to overlay that on top of the company's expansion plans, which really highlighted the risk from our perspective. And so that prompted lots of questions with the management team and how they were going to handle the stakeholders in that case. As you rightly point out, that's a very significant social issue if you're trying to expand in areas that have that level of scarcity. So as a result, that really affected the discount rate that we were using to value that company, and in really an appreciation of the potential for the risk that they were going into, or the potential for the risk of failure of executing on that strategy because of some of these issues. So that's a tangible way where we're able to, in this case, use a higher discount rate, which would lower the current valuation of that company, making it less attractive as an investment option. So we try to use those, in some cases, qualitative or subjective assessment of how management in particular will handle certain issues and translate that into, in this case, a discounted cash flow metric.
Okay, so if I understand you correctly, unless the clients asked you to specifically avoid certain types of companies, how you reflect ESG risks is via the discount rate?
Not in all cases, but via the valuation. So in this case, it was the discount rate that was used in a discounted cash flow valuation that was flexed. But in other cases, it might be a specific line item within our modeling. So as an integrated research process, we're building all of our own earnings and valuation models, which won't be surprising to you. And so it can come in different forms. We don't use a DCF or discounted cash flow calculation in every industry, so it will vary. So that's just one example of the way that can show up. But the point is the same, which is somehow we have to reflect this in the actual valuation for this to be comparable or to really drive a decision on a particular security.
So I'm going to ask you to take a stab at something, and I'm not going to hold you to the answer because it's a guess.
Okay.
But if you had to think across MFS's global investment research coverage, if you had to pick a percentage, and it's a guess, what percentage would you say are companies where ESG is really going to drive the result of whether or not you invest, whether it's via the discount rate or some other factor in the valuation, as opposed to companies where ESG, for whatever reason, is not a big driver in what they do?
It's a very high percentage, I would say, and I don't want that to sound like or imply that we're focusing more on ESG issues. We're focusing on the same issues we always have, which is trying to understand what are the key drivers of companies. And as I said before, it may just be because of the labels that are being used and more conveniently now, or more often now, but that is coming in too. So it's I don't really have a precise guess, but I would say it's the vast majority where worker safety issues are coming into play, water scarcity, income inequality, all the things that we've been talking about. It's really getting harder and harder to find a company that isn't going to be affected at some point by one of those things. We can call them ESG issues, you can call them something else as you like, just don't ignore them. They're going to have an impact on the valuation of those companies.
Okay. So I think it's fair to say it touches most organizations in some way.
in some way. And I think, from the corporate perspective, at least a lot of the dialogue that has come out from CEOs or CFOs in the last number of years, and within the ESG community overall, I think has been very focused on the E part of it. We know about the G, and that certainly has been going on for some time. I think the social element is certainly getting a lot more attention now, and I think that's over the last 12 or 18 months something that's continuing. We're continuing to hear more and more from CEOs about either their talent management, and certainly when you look in the technology space and areas like that, talent is critical to that. So companies are paying a lot more attention to the S. I don't think they present it that way necessarily, but when you dig through it, that's really the element that we're talking about here.
Okay. So you mentioned earlier in the conversation that there's this group of skeptics that still aren't really on board with ESG. I'm now going to play the part of one of those skeptics.
Okay.
I'm going to ask you some devil's advocate questions, and I'm very interested to hear how you would respond to some of these skeptical questions. Let me stress, I'm playing the part of a devil's advocate. These are not my personal ESG beliefs, but a lot of people out there probably have these questions. So our first ESG skeptic question: is ESG just virtue signaling?
I don't think so. I don't view it that way. I think it can be viewed that way, but without being cliche, I think we do need to focus on valuation, not values. Our fiduciary responsibility is to help clients achieve their investment outcomes over the long term. And I think what we're saying here is that saving for retirement and saving the environment are not in conflict. But our responsibility is to the former first, and that is to help investors meet their long-term goals. So that has to take priority over any imposition of virtues or values from our standpoint. That's certainly not what we're attempting to do.
Okay, I think you sailed past that one very well.
All right.
Next skeptical question: what's the big deal? Shouldn't every fund manager already be doing this? Aren't they already being paid to manage risk, and isn't ESG just another risk?
Yes. So everybody should be asking their manager exactly what they're doing and looking for the evidence of this. The one caveat I would make, though, is this is not just about risk. I think risk is a key element here, but what we're talking about also are opportunities, revenue generating opportunities, new businesses, new business lines, and a lot of our portfolio has some element to helping clients of these companies save money. So it's energy efficiency, et cetera. So there is an opportunity side of this. So I think we need to balance both the risk management as well as an understanding or an appreciation of where this can actually add value to a portfolio as well.
I'm going to stop playing skeptic for a second. I'm really pleased to hear you say that, because that's one thing I think is often lacking in the ESG debate, is that we talk about the bad actors, the bad companies, the things that are going wrong, and we never explore, or we rarely explore the potential to perhaps by companies that are fixer-uppers.
Yeah.
ESG may not be at a standard where it should be, but there's a plan to improve it.
Yeah.
And through engagement, we can help the company or reap the benefits of that company's improvement. I'm not sure if I'm putting you on the spot with this question, but can you perhaps give us an example of that positive side of ESG engagement?
Sure. I mean, I think, just to pick up first on your point, because I do think this is really how what's important to us overall, and that is that it isn't just about the risk. There are the opportunities here. We need to be able to balance both of those elements as we do that. There are many examples, as I was talking about before, but one thing that is important is that we're engaging with these companies to understand, is this an opportunity? Is this a risk? Are you doing this intentionally? What are your long-term plans to manage each of these elements? And I think when you have a negative screen or excluding whole categories of companies, you lose any opportunity to affect positive change. And so that is, again, a role that we see as an active manager engaging with companies, not only on proxy issues, but on fundamental issues to their business. And more often, we're finding that those are ESG related. So keep coming back to that theme. But, in chemical space, we think about certain names that we've owned over time. There's painting and coatings companies that are really helping drive energy efficiency for the shipping industry. So, what you use from AkzoNobel to paint the bottom of the shipping liners can improve efficiency. Those are the types of things that often don't get a lot of publicity, but I think those are minor or smaller areas that we can certainly find some good opportunities.
I'll switch back to being a skeptic again now. So academic research and empirical results often show that SIN stocks outperform. So I'm thinking of the update in the Credit Suisse Global Financial Yearbook. I think it had tobacco stocks going back over 100 years at a 20% plus annualized return. So given that some of these SIN stocks perform quite well, and similar things are true of alcohol stocks and weapons manufacturers as well, why should investors focus on sustainability?
Well, I think even if you're talking about these companies, when I say sustainability, I'm talking about the sustainability of that business or business model over the long term. And then what are again, starting with the investment case first and foremost, not the environmental case or social case or governance case. And I think those are brought into the equation after having an understanding of what is the investment thesis, what is the investment case to be made. And so in those areas that, as you refer to SIN stocks, yes, they have been, strong performing parts of the market. To me, that's not the entire point, which is what are we trying to accomplish within the portfolio? And so it's perfectly legitimate, in my view at least, to build a portfolio where an organization might not want to include those names. We have to have a discussion about that and recognize the realities that could impact relative returns, but it is manageable. There are substitutes in some cases within consumer staples or other things that we could invest in that get some industry exposure or some other trend that may be happening that doesn't perhaps include tobacco or alcohol or firearms or something along those lines.
I think that's a really good point. And if I think of my own personal experience, I had a grandfather who died from lung cancer when I was not even 2 years old, so I never really got to know him. So I personally would never invest in a tobacco stock because I've experienced firsthand the negative effects. But I'm also very well aware, as you just mentioned, that I'm giving up returns doing that. I'm comfortable making that call. And that's something that I've noticed is sometimes a bit missing in the ESG discussion, because everybody talks about the importance of being a fiduciary and having values and sustainability. They don't always talk about the point that sometimes those values may cost you return, but that's okay.
Yeah.
And there was a great piece of research that Cliff Asness put out from AQR on his blog probably about a year or so ago, called Virtue is Its Own Reward. I'm interested to hear your thoughts on this. Do you think the providers of ESG investment strategies should be talking with their clients more about this issue in terms of, well, having your values is a good and appropriate thing to do, but you may not be able to have your cake and eat it too in terms of returns?
Yeah. Well, I think that it's very difficult within, the kind of extended principal agent chain that happens within our industry. So you asked earlier about the end pensioner that we're actually here serving. But there are a lot of intermediaries in the way, whether that's at the corporate level, the investment manager, and then extending that out to the companies that we're investing in. So actually implementing that across a diverse set of pensioners is quite difficult, as we've referred to a couple of times, in order to capture each of those elements. So I think with the integration approach, it really is making sure that there's good alignment between the asset owner and the asset manager on what are the values that probably will be prioritized, if we can say it that way, within this strategy that reflect the beliefs or mission of the asset owner organization. And again, those are the types of dialogues that we want to be having with our clients and investors, because again, we're not going to try to impose the MFS view or my personal view on investors, particularly around the world, where you have many different very strong views from one region to the other.
One of the frustrations that I've had at times as a capital allocator is that a lot of the ESG research that I see seems to confuse several other factors together with ESG and then claim a result. I'll give you an example of what I mean. You'll get a lot of promoters of carbon neutral strategies, for example, and I'll talk about, well, we've created this index and we've reduced the carbon exposure of the index by X amount, but they haven't adjusted the index for sector or country risks, because obviously if you're eliminating companies that are heavy carbon producers, you're largely eliminating capital intensive industrial companies, and we know over the last 10 or 20 years those companies have largely underperformed. And as you said earlier, when you talked about the composition of the S&P 500, you can see that reflected in the composition of the S&P 500. It's the businesses that have intellectual capital rather than physical capital that now dominate. So I kind of wonder, and it's always been very difficult as an allocator when looking at these strategies, to actually tease out, well, how much of this is actually improvement due to ESG and how much of it is due to sector or country or some other factor that's getting mixed in.
Yeah.
Is there any tips or suggestions you can give allocators like me when looking at ESG strategies to sort of figure that out?
Well, I think that, a lot of these are the same thing, just using different language. And so parsing through that is what has gotten, in some cases, more difficult. And I think there's kind of the irony, and this is not new, but we've seen such a proliferation of data providers or data sources or rating agency on ESG. Clearly, this is an area where lots of people are focused on various commercial opportunities, and so I think we need to be a little bit careful about not over-engineering many of these processes, and that's why I like as you just referenced, the reference to intangibles. This is something that we've been dealing with for a long time within the investment space, and so we have to really be disciplined about which parameters are actually affecting the long-term valuation. And I think separating that valuation from, again, the values or virtues is an important step in this process. So there are some, great data providers out there, lots of rating agencies. We try to supplement sort of an overall view and another perspective, or that third-party view, with very specific data sets when we have an issue like looking at water scarcity, or the Carbon Disclosure Project, CDP, has a lot of great data sets on various climate issues that we can incorporate into our primary research as well. So I think it's finding that combination of maintaining the discipline of your investment style, but finding the right ESG data sources to really supplement that.
It's interesting to hear you bring up the topic of the research providers and their role in this process. I'd like to tell you a little story, a personal experience from the recent past, an experience in a portfolio that I was responsible for recently. And I'd like to get your thoughts on what I think is the moral of the story, and that is, where do you draw the line with some of these issues? Because it can be quite unclear. So I'll tell you the story, and then perhaps you can answer with your thoughts on where you can draw the line on some of these things. We had a stock in the portfolio, and that stock was Boeing. And Boeing is an interesting stock because depending on how some of the research providers look at it, it can be screened out for cluster munitions or not. So when we looked at it a little further, we found that Boeing's revenues, most of those revenues come from the production of airliners. There's a very small portion. At the time, I think it was around about 5% that came from the production of weapons. And one of the weapons that Boeing produces is a fighter jet. Now that fighter jet is capable of deploying cluster munitions, but Boeing doesn't actually make cluster munitions. So what we found was, depending on the research provider, and even within the same provider, depending on how strict you wanted the criteria to be, I'm thinking of one provider that had 4 categories of strictness, and Boeing was okay for the first 3 but not for the 4th. Depending on that, Boeing was either screened out or maintained. And it was an interesting case because a lot of fund managers from an investment perspective were attracted to Boeing because there's very strong recurrent earnings, because airplanes need to be maintained for 20 to 30 years, and so that means parts need to be bought, and it's a safety issue. So they were attracted to it from an investment perspective, but there were these ESG concerns about whether or not it was involved in cluster munitions. And as we saw last year, Boeing was one of the best performers on the Dow, a very strong performance. So I'm not asking you to talk so much about Boeing as a company, but just to illustrate this idea of where should we draw the line, because sometimes it's quite hard to tell what is or isn't acceptable.
Right. Yeah, and I think what you're highlighting is that there is a variety of ESG issues with any company, or at least a variety of ESG considerations. And so on the one end, there may be concern about cluster munitions. On the other end, there's a lot of good work being done on energy efficiency with a company like Boeing as well. So without getting into the specifics of every company, I think that is really the question that, quite honestly, I don't think we make on our own, that we have to do that in conjunction or in alignment with the investors that we are representing through that portfolio or through those investments. And so, and I don't mean to take the easy way out on a question like that, but I do think that there isn't a single strategy or one size fits all. That's the point, which is why I think integration is harder. It takes more energy, effort, resources, time, but I think it's a more durable process, and one where you can get at these things and have a dialogue between investment manager and asset owner on what is it that we're really trying to do. And that's, I think, one of the pitfalls of the screens is that if you screen it out, you never get the opportunity to engage or change behavior. And that's something that I think, I would want to hold on to as long as possible in order to not limit that opportunity set.
I think that's a very good point. And you mentioned earlier the importance of frameworks. And I think a case like Boeing really highlights why frameworks are important, because a lot of these ESG considerations have secondary knock-on effects. And you really need a framework to be able to deal with that and to deal with it consistently.
Yes, and I think that is the value of frameworks. It doesn't give you the precise answer each time, but it gives you the general answer and allows us to really communicate or triangulate around specific issues.
We were chatting before the podcast about Tesla as an interesting example of another company that has various ESG factors at play. Perhaps you could tell us a little bit about what you see in Tesla from an ESG perspective.
Well, I think it's an interesting example because it's often held out there as the almost the poster child of ESG with electric vehicles, and I think this is again coming back to the S part of this. So the labor force and the production concerns and safety concerns. And so this is one where certainly the ESG rating agencies had their highest rating on Tesla for some time. That came down earlier this year. But our fixed income analyst actually did a lot of the work around this when they were coming out with their issuance in 2017. And that's one that we passed on because of concerns around a very aggressive production schedule. Discussions with some of the labor force did highlight for us that there were concerns about safety and so on. So I think that's, to me, not again, to say that Tesla isn't ever going to be a good investment or something that we'd be interested in. But you have to do the work. You have to understand what's behind it. And I think there is, again, as I said before, a lot of window dressing on some of these issues. And I think we have to be very, we're paid as analysts or portfolio managers to be skeptical to a degree. And I think we need to ask the questions, but really verify what is going on and not fall for the story, but really look for the evidence.
So if I can summarize your response to my skeptical questions, it's really this: there's no replacement for doing the work. There's no easy answers because there's obviously a lot of issues at play, and sometimes the same company can have different conflicting issues, which is why investors really need a framework about how they're going to integrate this into their portfolio.
That's right, and I think, but there is good news in that as I said earlier, I think the evidence does show that a well-structured investment program, disciplined portfolio management, I do believe that we can accomplish or make progress on both of these goals: help people save for retirement, but also have an environment that is certainly comfortable to live in, both from a financial standpoint, but from an environmental, social, as well as an overall governance or framework perspective. So,
you mentioned some of these academic studies. Have any of them been able to put a number on the size of the impact that ESG investing can have?
I see a different number almost in each one. So some of it depends on how you describe it, but the number is I would say large and growing. But that's not much of a frame of reference. But I do think that if you think about impact investing, which is directly not in the secondary markets, but investing directly into companies, that's having an impact. Sorry for the pun, but also I think the tremendous amount of focus that we see across all investment managers, and certainly within the public equity space, there is tremendous opportunity to really make sure that we're tying these things together, not at the exclusion of one versus the other, but really tying these factors along with good investment practices that we've known for some time.
Just wrapping up, a couple of final questions. One final question on ESG, and then we'll move on to a couple of questions about you and investing more broadly. Where do you think the future of ESG investing lies?
Well, I do think that this is just now becoming and will become more mainstream. I think what we try to do is talk about our investment process. And within that investment process, there's research, and that research includes financial and non-financial factors. And the point I'm making is that we don't talk about our investment process and then talk about ESG. And I think that's still too much of how the dialogue goes in the environment today. So I think with better access to information about various ESG issues, more transparency, that will be ingrained into the investment process. And I think that distinction is one that's necessary today, but won't be necessary in the future.
Further integration is on the cards, I guess.
I believe so.
This is a question I love to ask experienced investors such as yourself, somebody who's been in the business as long as you have. What lessons did you have to learn the hard way in your career?
For me, it really is around having an understanding from multiple perspectives. I think that's what I have tried to do, both in any involvement I've had in the investment process. More recently, I've been involved more in the management side of things, and it really is about empathy and understanding the perspective of somebody else. And a lot of times, I guess that was ingrained in me early on. And a lot of this comes out from just doing different projects in big organizations where you have accountability, but not necessarily authority. And so how do you kind of build relationships and go through that negotiation? So that's a skill I think that we all need in a very dynamic world, and having a little bit of empathy and sitting, trying to truly understand the problem that a client is trying to solve or another investor is trying to solve, rather than just what I'm trying to problem solve for, I think is something that became necessarily at a very early stage and has stuck with me.
I think that's a very, very good lesson, and I think we could all do with a bit more empathy at the moment.
Yeah.
So can you give our listeners 3 tips to improve their investment decision making?
Well, you won't probably be surprised at this point to hear me somewhat repetitive on this point, but I do think that first and foremost, it is having a long-term perspective. As savers, as investors, we need to really consider what is the purpose of that money I'm saving. If it's for retirement, then that's has a very long shelf life, and so we need to have that long-term perspective. And I make that distinction because I think there is a lot of noise in the marketplace. There's a lot of noise within ESG with all the different data providers coming in. So sticking to the long term, I think, is point number 1. Following on to that, I would say is a discipline. Write down why you own the security and refer back to it often, because it will change, or the circumstances or the information in the marketplace will change, and it's a good reminder of why you set out in that direction in the first place. So I think that's important. The last thing I guess I would say is I think it's important for investors to have what I would call countercyclical courage. So don't follow the herd, and I think that's true when you're screening out names or thinking about what's going on in the marketplace. It kind of comes back to this: you got to do the work, got to have independent thought, need a network of trusted partners that you can bounce ideas off of, and if you do that, I think you can have some countercyclical courage, which is really where we can take advantage of some of the short-term noise in the marketplace.
Okay, I think that's all very good advice. Long-termism, discipline, and courage when required.
Right.
I think we could all benefit by implementing that advice. So where can listeners find out more about ESG investing and more about MFS's approach to ESG investing?
Our website, mfs.com/sustainability, has everything that we're doing at the moment and a lot of our historical reports from a proxy standpoint. So certainly that would be one stop that we think would be worth making.
Very good. Well, Mike, it's been a pleasure having you on the podcast. Thank you for joining us today, and travel safely back to the US.
Thank you very much.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.